All right, hello, and welcome to Camel Finance. I'm your boy Camel, and today I want to quickly point out something about rate hikes. Then I'm going to go through some charts, as we always do for the weekend. I'm going to examine the closes, show you all my positions, show you any changes or modifications, and how I'm looking to position as a pro swing trader into next week. I also have been highly requested to explain this trendline strategy, my trading strategy a little bit, and so I'm going to do that for you. I'm going to do that. But I want to preface this by saying you're going to be possibly quite shocked at just how simple it is. Over the years, what I've found is I started my trading career with loads of moving averages and RSIs and all these other indicators. And I used to use a parabolic SAR, stop and reverse, for a while. I also used to start at a monthly chart and then go to a weekly and a daily. And then when I was in my trades, I'd work down to a 4-hour or a 2-hour chart. And over the years, I just started to strip away more and more things. And so when I tell you my strategy is I draw a trend line, and when the trend line breaks, I buy, then you might be thinking to yourself, it can't possibly be that simple. But what I've found is all of the indicators are, to me at least, delayed. They're all lagging and they're all derived from price, right? So that's why personally, and if you use indicators, there's nothing wrong with that. There's a million ways to skin a cat or a million ways to make $1 million, whatever the saying is. But for me, like a moving average averages the prior 20, 50, 200 days of price action. So I'm not saying it's useless. I'm not saying it doesn't act as support and resistance, because I'm sure it does. But for me, why do I want an average of the prior 20 days or 50 days? In my mind, I just want what the price is doing right now, right in this very moment in time. So going into this sort of tutorial, if you want to call it that, try to keep an open mind, because when I tell you it is this simple, I've seen this over and over again. I've taught a lot of people in the past. I've shown a lot of people this strategy, and I will even give them this strategy with a few 3 or 4 rules. And then I notice the first thing they do is they send me a screenshot of a chart and it's got like 5 indicators on it. And I think, where do you get those from? I didn't say anything about that. But it's difficult for some people to just flush out all of the noise and say, what's the price doing? Has it crossed the line? That really is all you need. Now, if you want to add indicators, you can add indicators. That's not the point. The point is, it really is that simple in terms of technical analysis. But keep in mind, being able to draw a trend line and put a buy on once the price has crossed that trend line doesn't make you a good trader, doesn't make you able to make money. The hardest part of trading, the part that requires the most amount of training, discipline, practice, and years of experience, is being able, one, not to mess around with your trade. So if your strategy is to long a breakout and put a stop in a certain place, the hardest part about that is having the patience to wait for that setup. It's also really hard for most people, once they're in a trade, to actually manage that trade. It's really difficult to sit on your hands, and if the trade starts to move into negative, if you start to go into open loss, a lot of people start moving the stops around, they start hopping in and out of trades, they start adding or removing exposure, and that was never the original point. The point was, if we get a trend line break, we add the long, we put the stop, and then we move on and we wait to see how the price goes. So yes, the strategy is super easy. You could learn it in 10 or 15 minutes. I'm sure you're going to today. Remember, what's hard about being a trader, what takes the training and the skill development, is the ability to stick to this strategy, to not go interfering with a position when you're halfway through it, to not start doubling down if you take a stop loss. That's a big thing. People, like, they get stopped out once, twice, 3 times, and then they go, oh, I got to win this back, and they put massive amount of exposure on. Keep in mind, this strategy, it oscillates between 40 to 60% win rate. That means around half of my trades on average are going to be stopped out. So that also means that with a 50% win rate, every 8 trades, I'm going to get 3 in a row that lose, right? Or 3 in a row that win. Think about it. If you flip a coin enough times, you're going to see a run of heads or a run of tails. So it's important to understand the maths. It's important to understand that if you don't always size your trades at 1 to 2% account risk, then you're going to get a run of 3 losses in a row every 8 trades. And when you do, if you've got 30% risk on your stop, or you keep doubling down every single time, you're going to blow up in 4, 5, 6 trades, right? That's the part that takes the skill. That's the part that takes the discipline. It's really, really hard to consistently only use 1 to 2%, especially when you start to win. If you go on a winning streak and you have 3, 4, 5, 6 trades in a row, you start to think, that's it, I've cracked the system, I've hacked the matrix, I'm the best trader to ever touch a chart. And then the first thing you do is you start adding massive exposure. You start taking on even more risk. And if you know you've got a fair coin that's 50% right, 50% wrong, and you've just had a run of wins, and then you start adding to exposure, then you start increasing size, the only way mathematically this can work is for you to then start taking big losses. And that's likely what you've experienced if you've tried trading. You get a few wins, you start to think you're good, and then you give it all back, right? And then you get a few wins and you do a lot of hard work and you build that account up and then you give it all back. And it's because the hard part is not the TA, it's not the trade entry, it's not pushing the buy button. It's being able to stick to a well-defined risk strategy. So with all that said, let's get into today's episode. First of all, shout out to Z here for bringing this to my attention. Powell has said that rates may not need to rise as high given credit stress. And immediately upon this statement, what we saw was the rate shift from 60% on a pause and 40% on a hike to 80-20, as you can see here. So this is probably going to jump around a bunch more times between now and the 14th of June. But so far, we're still looking out towards a pause that still should give us space to see a melt up unfold, or at least a run towards all-time highs. If you look at the DAX, let me pull up a DAX chart for you. The DAX is at all-time highs, okay? I believe so is the French stock market. The FTSE 100 is close to all-time highs. We are slowly starting to see this unfold. What's the Nikkei looking like? Again, all-time highs for the Nikkei, or at least 33-year highs, something like that. So we are starting to see this blow off top develop. It just hasn't reached the US equities yet. But it will. It will. I mean, do you really think in a bear market rally, all these Asian and European markets reach all-time highs? Do you really think that's how a bear market rally works? I mean, as far as I can tell, the stars are aligning well here. So as long as we can get that pause, we should be able to front run that pause. The markets should indeed do things such as this, and then we should have a good chance at least seeing some further gains over the next month or two. As ever, one day at a time. So how to draw trend lines? Well, I'm not going to teach you how to suck eggs. I'm sure you already know this. You just connect a trend line to touch the wicks. Now, I personally use the wicks, okay? You can use the closes. You can use some of each, okay? It's entirely up to you. You can do whatever you want. You can draw them however you want. Don't ever let anyone tell you how to do you, okay? You can just do whatever you want. So I personally have found I prefer to take the wicks. You get a later entry, but it is more likely to confirm and follow through as a breakout in my experience. If you want to use the closes, if that's what you're more comfortable with, then switch yourself onto a line chart. It will just make everything a lot easier to use the closes. In terms of diagonal trend lines, a lot of people don't like them. A lot of traders say diagonals don't really exist, only horizontal levels do. But I don't really see the argument for this, since I've been drawing and making money from diagonal trend lines for most of my career. So I don't really see the argument for this, but each to their own. Some people prefer to use horizontal lines only. That's fine. Again, you do you. The next sort of rule that is useful to know, I think, is it's important to use the daily closes, because a wick can happen. So if we wick up here and we don't close above and we come back down here, then using the daily closes will keep you out of these wicks, okay? So I always like to see a breakout that is closed on a daily candle. This is a chart of the Dow Jones. So the bigger the trend line is, the more touches like this, then the bigger the breakout is going to come and the more likely it is to be calling a true turn. It's also of note, the less steep this angle is, the more likely it is to succeed as a breakout. And the more steep, like this, see how this angle here is much, much steeper than that one, then the steeper the angle, the less likely it is to succeed as a breakout. For the S&P 500, this is an S&P 500 chart. Something else that's interesting about these trend lines is they're really good at calling the bottoms. So as you've seen, we've done that live on the channel with the other one. If we connect this high here, and these for the C19 plunge, you can see a trend line break here will get you in as close to the bottom as necessary before the big turn. And you can also see that it gives you plenty of opportunities all the way through each one of these pullbacks to connect the lines and buy the breakout. Sometimes they throw back, as you can see here. This time we broke out, threw back to the breakout level. But if we'd put a trade on here, this is kind of what I was alluding to at the start. So we buy long here, we put a stop below the lows, as you can see. So the difficult part in trading is if it starts to break out, you start to think, oh, ideal, this is really good. I've got loads of money. I've made a nice profitable trade. And then it comes all the way back here. As it starts to pull back, you have to be fighting your own urges to say, oh, no, I don't want to, I had a lot of open profit and now I'm back to near break even. No, now I'm in a loss. I'll just close my trade. And then of course the market reverses again. So it's important to let your stop do the worrying. The hard part of trading, like I said, is not drawing a trend line and buying here. Anyone can do that. The hard part of trading is being able to manage your risk. You keep this stop the right size, 1 to 2% of your account, and then you let the market give what it's going to give. So that's in a bull market. Another nuance to this technique is when we're in a bear market like last year, we did several times, I can't remember exactly, but you can go back and check this out if you want to see. We did draw some trend lines. I think we took this one here. But we took a long, rode it to the top and then jumped out somewhere around here. I know I definitely took this long out of here. So again, you draw the trend line, you buy the break, and then you see what the market can give. I think we ended up having to sell here once we took this out, and then we waited for a cycle low and a break of the big blue one, and we got long again, and I've been riding this up to around here, I believe. I think I also took this one live on the channel here, something like that, and then out here, and then we bought the cycle low just recently, and now again we've got a breakout of this much less steep one in purple. So for me, the idea that diagonals don't work is ludicrous. I've demonstrated on this channel time and time again they do, but a lot of traders don't like them. I think one reason traders don't like them is they often talk about how trendline traders like myself have to sometimes move the line. So if I drew this line like this, right, and then we got this sort of fake breakout here, what I would do is I would move the line to include that wick and then go again here. And a lot of people will say, yeah, well, there you go. That proves it doesn't work. That proves it's not a real strategy. That's not real support and resistance. But it works. And in my mind, the reason this works is, one, I don't have any emotions in the market, right? I don't care. If it breaks out here and fails, fine. Well, I just learned something. That is not the right trend line. That's not the right level that the market is respecting. The market is respecting this level, connecting that wick. And you can see now we've found the level that the market is respecting. Now we can have a second crack at it and go again. I often move the trend lines, not often, but sometimes I've definitely done it multiple times on the channel. Sometimes I move them and I don't have a problem with it. So again, don't let anyone ever tell you how to do you. So for me, it really is that simple. Now, once you're in a long, the question becomes, how do you sell? And I think another thing traders really struggle with is they spend so much time focusing on how to buy without ever really spending any time for how to sell, right? But the beauty of this is it really is the same thing. We just draw another trend line. And if I invert this chart, you'll see exactly what I'm talking about. Look, this is that same chart upside down. Now, if you imagine it's not upside down, we connected this trend line. When are we looking to get long here? Well, we'd be looking to get long when the price eventually finds its way back to this line and then breaks out, right? That would be our trigger for our long. So because this is upside down, it's a short or a sell this time or an exit. And that's just as simple as that, isn't it? So I like to use this strategy. It really is as simple as that. Here it is again on the NASDAQ, right? We took a long out of here and we sold a sharp trendline breakdown, which was here. So again, this speaks to once the angle is very steep, the likelihood of it not being a strong or high confidence setup is higher than if it is less steep, like this red one. So we got long here, I think, on a breakout of this downward sloping blue resistance line. Then when we broke down here, we jumped out of this trade. And then we got long again, as you can see, on a break of this downward sloping green resistance line. Now, since then, I've been consistent in saying that once we lose this upward sloping red support, I don't want to be anywhere near longs. We can extend this out. So all the while we're above that upward sloping red support line, we can continue to push this long, right? All the while we are doing something like this and continuing up, then it's fine. But the moment we come down and break out of here, what does that look like on an inverted chart? Well, if we flip this upside down, you can see that's just a bullish breakout, right? So we have to exit the trade here or go short because it's the exact same thing upside down as what we got long in the first place. A couple more things to note. This is a momentum-based strategy. So all the while we have truly broken out like we have, all the while we are truly trending up and continuing to make higher highs and higher lows and holding this trend line, then this will keep us in the trade. We will be able to continue to ride this trade. But I will never be able to sell the exact top, nor will I ever be able to buy the exact bottom because I'm always waiting for market confirmation in the form of a breakout or a breakdown. So if this is to continue being a powerful uptrend and we have some big kind of melt up, then this red trend line will get extended out and we'll get out pretty close to the top. But I'll never actually be able to sell the top. And there are times when sometimes you start to kick yourself because say the market does this from here and then breaks down. Well, then it's obvious in hindsight to say, oh, I should have just sold here, right? I should have just sold here instead of letting it come all the way back down. But again, that's not how you push the trades. How you push the trades to get the most amount the market can give is to make sure that you're in the trade until you have a technical reason to exit. And Apple's a very good example of this as well. So we had our first breakout here, as you can see from this downward sloping blue resistance line. The angle's not too insane, is it? It's not like super steep like this one, as you can see. That was steep. It worked for a bit, but it failed thereafter quite quickly. And there is another steep one, roughly in that neighborhood. Let's try and draw that a bit better. There's another one, roughly in that neighborhood, which did not fail. But as you can see, the steeper they are, the less trustworthy they are as well. Anyway, there is an initial long entry from down here. Then what we did was we trade sideways, but at the time we had not yet established a true level of support. So the original line for the trade was like this. Again, steep, steeper, more likely to fail. So we get the breakdown, we get the exit of the trade. Then the market proves to us that it has broken back above this high. And so now we have a much more reasonable angle of attack. Now we've got a well-established, true up-sloping support line, and the angle is far more reasonable for a sustained rally. Now, there's been multiple times during this rally that you could have said, oh, maybe I should get out, maybe I should get out, maybe I should get out. But as you can see, all the while on a daily closing basis, we're above this blue upward sloping support line, then we can continue to push this trade. And if this was to break down over the next couple of days, fine. Then we've caught the bulk of this move from here to here. But if it does not break down over the next couple of days, because there's no telling, nobody knows what's going to happen. It could just do this, right? It could do this, and we could end up drawing this trend line all the way out here, and then finally it breaks down at 200-ish, and then that will be an absolutely monster trade. So this is how I've always traded. This is how I, at least once I started to get very good and profitable at trading, this is my strategy. As you can see, there's no indicators, there's no RSI, there's no none of that. And I'm not saying that stuff doesn't work or it can't be used effectively, but for me, this is all I need, and this is all I do. It's the same technique, but inverted, isn't it? So we buy long when we get a trend line break, and then if we invert the chart, you can see if this was to break down, then it's time to exit the trade, right? It's time to even look for shorts at that point. So I hope that helps. Again, I'm sure some of you will be sat there thinking to yourselves, it can't be that simple. It can't be that simple. But believe me, it's easier said than done. It's really easy for you to draw your own trend line and say, okay, when the price breaks, I'm going to buy and I'm going to put a stop just below the local lows. It's really easy to say that, but can you do it? Can you do it consistently? And can you not defeat yourself by keeping your position sizes consistent? Can you calculate the amount you're going to risk on the stop loss at 1 to 2% based of your overall trading account? And can you stick to that plan? Can you, if you get 3 winners in a trade, decide to yourself you're not going to double down on the next trade, right? And if you get 3 losers on a trade, can you decide you're not going to shove all in on the 4th, right? That's really what trading is about. Slow and steady wins the race. We're not trying to make massive sums of money right away. Think about it. If you start with a $1,000 account, you're risking $10 on a trade, right? But over time, that $1,000 will grow into $10,000, and then you'll be able to risk $100 per trade. And again, within some years, you'll be able to grow that up until, before you know it, you're finally making the type of money and trading the type of size that you always dreamed about. But the only way you get there, the only way is if you can make the decision not to harm yourself, not to be a gambler, not to shove all in, not to oversize on your trades. That's the only way you can be around for the long haul. Have one strategy, whether it's this strategy or something completely different, that's irrelevant. You can roll a dice or flip a coin, and I'm sure you could probably still make money so long as you stick to 1 to 2% account risk and you don't self-harm and start thinking you're good or start thinking you're bad, because the only way that ends is by being humbled by the market. You can always tell who the real traders are because they'll tell you they have no idea. They've been humbled enough times. If they're still around after all of that humbling, they're not going to be telling you, I know what's going to happen. I can guarantee that. So anyway, I don't know how long this video is going to be. It feels like I've been talking for an hour. Let's run through the charts. So S&P, if I remove my green squiggle so we can see what's going on, seems to me like we have indeed got a cycle low off of this double bottom. Also seems to me like we've now confirmed that cycle, taking out that high and the downward sloping purple resistance line. So again, I don't know what's going to happen. Nobody does. But we do know we got a cycle low due somewhere around the 30th of June. So it's reasonable, in my mind at least, to expect some further upside before a drop into that cycle low. It could certainly form lower down than that. It could end up looking much more like this. It could even do something like this, right, and form much lower down. Nobody knows. But all the while we're above this red upward sloping support line, all the while we're above this downward sloping purple support line, then there's no technical reason to exit the trade. So I remain long and strong on the S&P 500. The Nasdaq, sort of half already covered this, haven't we? Right now, just poking above these local highs. Do you notice that? So some level of rejection here, some level of pullback into this support would be perfectly reasonable. But again, all the while we're above this, there's no reason to exit the trade. Dow Jones working on a breakout, as you can see. Breakout, possible retest before resumption higher. So we'll see if it can happen. If we can get a couple more candles closing up here, then I think we can move the stop just below this local low here, because we should, in theory, have a new cycle behind us. So stops at break even. We'll see what the market can give on that. Here's the VIX. Again, still refuses to spike, doesn't it? Still looks like possible chance of recovering here, but it doesn't speak to a stock market volatility event just yet. Obviously, the debt ceiling talks are a couple of weeks away now, and they could certainly cause a volatility event. They could certainly cause some big spikes in the VIX and some big crashes. But as it stands, one day at a time, we're still looking for the VIX to compress as the market completes the rest of its cycle. UKX, again, another illustration, isn't it? Steeper line, less confidence, less steep line, more confidence. So this is still open to failure. But if we can get up above here, expect to see me add along for the FTSE 100. Apple, we kind of already been through. As long as we're above this upward sloping blue support line, then perfectly reasonable to continue to push longs. Here's IPX. So we've had a breakout, retest of this sort of breakout level, and possible resumption coming in the following week. That is to be determined, but for now, we're long, we're strong, and we'll see what the market can give. Gold, there's a lot going on in this chart. It's all about this one here. And again, if I invert the chart, you would be wanting to buy if this was the right way up, wouldn't you? If we cross this blue line, you'd be wanting to say, that's a breakout, I'm long. So if you're a gold bull, you don't want to see this line break down, or perhaps you do so you can add more gold. I kind of expect, to be honest, to see something like this because we've started to set a trend line here in red. So that would make sense, but whenever we get down there and then break out, that would be a really, really nice opportunity to long the precious metal markets. Not really interested in silver or the miners until until I can get a better read on gold. I don't really have a good read on gold at the moment, so I just want to stay out of the way of it until I can figure out exactly what's going on. But I am quite sure that we're going to see a good test of this upward sloping blue support line first. The dollar following my green squiggle, I can't even see where the candles are. So possibly just about to reject off of this yellow line, as you can see. Are we going to get that rollover? Are we going to get something like this unfold? That would be perfectly logical, wouldn't it? That would just be a move straight back into resistance and a rollover whilst we complete the melt up. Of course, there's a chance that we could break out here, but until that happens, I'm not going to worry about it. The 10-year yield could well be putting pressure on risk in the near term as well. As you can see, this is starting to break out, isn't it? So this is starting to move higher. It's sort of cleared all of this recent consolidation. So we have to keep an eye on this. Is this pricing in another 25 basis points? I think it could be. And the same for the 2-year yield right here, as you can see. TLT moving down to the bottom of the range. So no recession trade as of yet. Remember, the recession trade comes from a breakout here, but we just haven't seen that yet. Again, kind of speaks to a more risk-on look in the short term. And Bitcoin, what is Bitcoin doing? It's trying to make a decision, isn't it? It's trying to decide whether it wants to absolutely dive down here or whether it wants to break out and do Bitcoin things. So whichever one comes first is anybody's guess. But for now, we're still holding above this cycle low, so we still have a new cycle in place, and we just have to see what the market can give. Same is true of Ethereum, isn't it? So hanging around break even, we'll see if that low holds or not. Kind of already covered XRP. I was talking about a potential scenario where Coinbase was being rumored to relist XRP, and I didn't really believe it. I think I made that quite clear. But I said if it were to happen, then we would see a breakout and we would probably put a long on that breakout. As it stands, the news that came out was related to a new zero fee trading system or something that they're about to launch. So XRP not going to be relisted on Coinbase. Not really surprised, to be honest. And therefore, I would expect this to be the start of a rejection lower. I would not rule out some kind of false dawn bull trap here that then sharply reverses like this. So if you are thinking about long in a breakout here, assuming it even occurs at all, I would caution against that. I would just be aware that running these stops from above this high would be perfectly reasonable and a good way to trap longs on a move that looks like this. So just be open to that. I still am championing this green squiggle of mine, and I still think that once we eventually get somewhere in this neighborhood, it's going to be a really, really big trade for the year. And lastly, the crypto-related equities. Look, we got a breakout with a retest, so no push off just yet. Is that coming or are the stops coming? That is to be determined. MicroStrategy showing a bit more relative strength than Coinbase is, as you can see. Lows still in place, slight profit, so we'll see what the market can give there. The same is true of Riot, isn't it? Still kind of very much consolidating above the blue horizontal here. I'm just wondering if we redraw this trend line, do we get a better look? Maybe, maybe not. This is a bit wonky, I'm not going to lie. But for now, we're certainly above this horizontal, so we'll see what the market can give. And Marathon, as you can see, it's kind of the same story, isn't it? Still hanging around, consolidating here, compressing. So it speaks to a big move, but the direction is to be determined, of course. So I hope you found that useful. I hope I wasn't too long. And most importantly, I hope you're doing well in life. I hope you have a great weekend, and I'll see you next week. In the meantime, look after yourselves. Take care from me. All the best. Cheers. Bye.